If I told you that one of the most celebrated assets of this decade is standing on the same cliff edge as the dot-com bubble, the 1987 crash, and the housing collapse of 2008, most people wouldn't believe me. But I've learned something after nearly 9 decades of watching markets rise and fall. Every bubble looks invincible right before it breaks. And today, Bitcoin is showing the exact same fingerprints I've seen before every major financial disaster. Not because of technology, not because of innovation, but because the core math behind it simply doesn't add up. And when the math doesn't work, nothing else does. I didn't arrive at this conclusion overnight. Nothing I say about Bitcoin comes from impulse or emotion. It comes from decades of watching how investors react whenever something new enters the financial world and creates excitement. I've spent my entire life observing human behavior in markets, how people think, how they get influenced, and how quickly rationality can disappear the moment something looks revolutionary. When I was a young man, people were convinced that radio would transform the world so dramatically that any company with the word radio in its name must be worth a fortune. It didn't matter if the business had no profits, no customers, or no clear plan. The excitement alone was enough to convince thousands of people to invest. And this pattern repeated itself again and again. In the 1960 seconds, we had the so-called tronics boom, where companies simply added the word electronics to their name and instantly saw their stock prices soar. The business didn't actually change at all, only the name changed, but investors poured money into them because they were afraid of missing what seemed like the next big future. Then in the 1990 seconds, the dot-com bubble took that same psychology to an even bigger extreme. All a company had to do was add .com at the end of its name, and suddenly it was valued like a world-changing empire, even if it had no revenue, no profit, and sometimes not even a working product. The story was enough. The hype was enough. The possibility was enough. What I learned from watching these cycles for more than 70 years is that people don't change as much as they think they do. The technology changes, the vocabulary changes, the marketing changes. But human behavior, the excitement, the fear of missing out, the belief that this time is different, that stays almost identical across generations. And every time, the ending is the same. Hype collapses, reality shows up. And the assets that had no real ability to produce value fall back to where they always belonged. You see, my work at Berkshire Hathaway has always been guided by one simple principle: buy productive assets, buy things that create value, buy businesses, land, equipment, or companies that produce something real: cash flow, earnings, profit, goods, services. A farm produces crops. A factory produces products. A well-run company produces profits. Even a bond produces interest. These things have tangible, measurable outputs. They give you a way to calculate what they're worth. Bitcoin does not. Bitcoin produces nothing, earns nothing, and generates nothing. It doesn't manufacture goods. It doesn't provide services. It doesn't send you dividends or interest. Its entire value is based on the hope that someone else will buy it from you later at a higher price. That is speculation, not investment, and that's not an insult. It's simply the truth you discover after watching financial history repeat itself long enough. After 7 decades of studying markets, the lesson becomes crystal clear. Anything that cannot produce value on its own eventually returns to its true worth, whatever the next buyer is willing to pay. And when excitement fades, that number usually isn't very high. That is why my views on Bitcoin are not emotional. They are logical, consistent, and based on a lifetime of observing the same pattern repeat itself in different forms. Let me walk you through this slowly and logically, because in investing, clear reasoning matters far more than excitement. Whenever I evaluate an asset, I begin with the same simple question: what does it produce? Not what people say about it, not what headlines promise, not what the price did yesterday. What does the asset itself actually create? If you buy an apartment building for $1 million, you can calculate its value in a very straightforward way. You can look at the number of units it has, the rent each tenant pays, your yearly expenses, and the expected profit after everything is paid. If the property gives you $80,000 a year after expenses, that income becomes the anchor of your investment. You can project it forward, adjust for vacancy, increase rent over time, and arrive at a realistic estimate of what the property is truly worth. Even if the real estate market crashes for a few years, that building still produces money. It still has value. Now look at a business like Coca-Cola. It has factories, distribution networks, management teams, employees, brands, customers, millions of people buying their drinks every day. Last year alone, Coca-Cola sold more than 2 billion unit cases worldwide. From those sales, after costs and taxes, about $12 billion of net income remained. That money belonged to the shareholders, not because they were lucky, not because the stock price bounced around, but because the company produced value. When you buy shares of Coca-Cola, you're essentially purchasing a portion of those profits. The same logic applies to any productive company. Apple earns around $100 billion in annual profit. American Express produces strong returns because people trust the brand and use their services every single day. These businesses create something. They generate wealth. Now consider Bitcoin. If you buy one Bitcoin for $50,000, what have you purchased? You haven't bought a business. You haven't bought land. You haven't bought a farm, a product, or a cash-producing machine. You bought a digital token whose value is entirely dependent on what someone else is willing to pay later. There are no earnings, no dividends, no interest, no factories, no customers, no employees producing value. There is nothing growing underneath it. If you own a farm, you don't have to hope someone pays more for your crops. You just grow them. If you own a factory, you don't have to hope the market gets excited. You just sell products. If you own a solid business, you don't wake up every morning praying that demand continues. You earn money because the company functions and serves real needs. Bitcoin, on the other hand, produces nothing. It is only worth more when more people decide they want it. When the excitement slows, the price stops. When fear enters the market, the price collapses. It behaves purely on emotion and perception. And perception is one of the most unreliable forces in all of finance. Consider this. The annual electricity consumption used to mine Bitcoin is roughly equivalent to the entire energy usage of some small countries. That energy isn't producing food, medicine, shelter, or anything useful. It simply exists to maintain the system. It's a cost without output in economic structure where the expenses are enormous, but the productivity is zero. Now, there's something else people forget. Real assets can be analyzed using numbers. Bitcoin cannot. You cannot create a reasonable financial model for something that has no earnings, no cash flow, and no measurable ability to produce anything in the future. The only model Bitcoin has is hope that the next buyer will be more optimistic than the last. That is not investment, that is speculation. And speculation has a long history of rewarding a few early participants and hurting the majority who enter when the story is loudest and the excitement is highest. Investing, in its purest form, is the act of laying out money today to receive more money in the future because the underlying asset produces value. Bitcoin does not produce value. It simply trades hands. And if the enthusiasm ever stops, the price will fall back to whatever the market truly believes it is worth, which, without productivity, is anybody's guess. The biggest risk with Bitcoin isn't the price falling tomorrow or next week. Markets rise and fall all the time. That's normal. The real danger lies in something far more subtle. Most people who buy Bitcoin don't actually understand what they're holding. They don't understand how it works, what determines its price, or what could make that price collapse. And in my experience, the most dangerous thing in all of investing is confidence without comprehension. I've lived long enough to see what happens when people believe they've found a shortcut to wealth. It always starts with the same emotional cocktail excitement, fear of missing out, and the belief that everyone else is getting rich except you. That combination alone has destroyed more fortunes than bad business decisions ever have. Let me explain why this psychology is so dangerous. When an investor doesn't understand an asset, they can't distinguish between a temporary price decline and a permanent loss of value. If you own a good business and the price drops, You can examine the company's numbers, its sales, its profits, its balance sheet, and decide whether the business is still strong. But with Bitcoin, you don't have those tools. There are no earnings to check, no customers to study, no cash flow to measure. You're left guessing. And when you're guessing with your own money, emotions tend to make the decisions for you. During the dot-com boom, millions of people invested in companies that had no revenue, no business model, and sometimes no product at all. They bought shares simply because everyone around them was doing the same. People would tell me, "Warren, you're too old-fashioned. This is a new world." But when the bubble burst, the NASDAQ fell nearly 80%, and trillions of dollars in paper wealth vanished into thin air. I watched smart, hard-working people lose their life savings not because they were foolish, but because they trusted a story instead of understanding what they owned. Bitcoin follows that same pattern. Its value rises not because it produces anything, but because people expect it to keep rising. That's the definition of a speculative bubble. And the truth about bubbles is simple. They always need new buyers. The moment new buyers slow down even slightly, the price becomes unstable. If sentiment turns negative, the price doesn't gradually decline. It collapses suddenly because its entire foundation rests on faith rather than fundamentals. There is another risk most people never think about. Bitcoin depends on a network of miners, on electricity, on exchanges, on digital wallets, and on infrastructure that can be hacked, shut down, regulated, or disrupted. A farm will still produce crops even if the internet goes down. A business will still operate even if a government bans certain software. Bitcoin, however, relies entirely on constant technological functioning and the willingness of millions of people to continue believing in it. And then there's regulatory risk. Governments have the power to intervene when they see financial behavior that threatens stability. We've watched countries restrict or ban crypto trading. We've seen major exchanges collapse overnight due to mismanagement or fraud. When an exchange holding billions of dollars goes bankrupt, investors don't just lose money, they often lose everything, with no insurance, no protection, and no legal recourse. When people say Bitcoin is digital gold, they forget that gold has 5,000 years of history as a store of value. Bitcoin has a little over a decade. That's not disrespect, it's reality. The financial world has seen many promising ideas fail, simply because they couldn't withstand time, regulation, or economic pressure. And I want to say something important here. I'm not predicting a specific date or event. I don't have to. History tells the story. Every asset class built solely on enthusiasm, without underlying productivity, eventually reaches a point where belief weakens. When that moment comes, the decline is fast, deep, and unforgiving. If Bitcoin depended on earnings, it could fall 20% and still make sense. If it depended on cash flow, it could drop 30% and remain a reasonable investment. But when an asset depends only on psychology, the risks are not linear, they're exponential. One piece of bad news, one regulatory change, or one shift in sentiment can erase years of price gains in a matter of days. This isn't a prediction of doom. It's a reminder of how markets behave when excitement outruns understanding, and the people most harmed are usually the ones who joined late, driven not by knowledge but by emotion. I've seen this cycle too many times to ignore the warning signs. The first rule in investing is simple enough for a child to understand: never lose money. And the second rule is just as important: never forget the first rule. These two ideas may sound obvious, even repetitive, but they form the backbone of everything I've ever done in business. They force you to think clearly, behave rationally, and stay anchored when everyone around you is getting carried away by excitement or fear. And the reason these rules matter so much is because they're built on a deeper truth. Real investing requires patience, discipline, and an understanding of how value is created. To follow those rules, you need something solid to hold on to, something with a foundation, something that allows you to evaluate whether what you're buying is worth your money. My anchor has always been intrinsic value. Intrinsic value means the amount of cash an asset can realistically produce over its lifetime. It's not about trends. It's not about momentum. It's not about opinions. It's about what the asset can generate in real dollars. If you buy a farm, you don't pray for a higher price, you plant seeds and grow crops. If you buy a business, you don't depend on enthusiasm, you sell products and earn profits. If you buy a bond, you don't rely on social media trends, you receive interest payments regularly and predictably. These things give you measurable reasons for your investment. You can calculate them, track them, and make informed decisions based on facts, not feelings. Now, compare that to Bitcoin. Bitcoin has no intrinsic value. It doesn't produce anything. It doesn't generate profits. It doesn't send you dividends. It doesn't grow commodities. It doesn't serve customers. It doesn't offer a product or solve a real economic problem. Bitcoin's value exists only when people agree it exists, and that agreement is both volatile and unpredictable. People often tell me, Warren, you just don't understand modern finance. But I fully understand the difference between productive and non-productive assets. I've lived long enough to see dozens of so-called revolutionary investments promise the world and fail to deliver anything meaningful. The common thread is always the same. When something depends entirely on optimism instead of output, it is vulnerable to collapse the moment optimism fades. That's the difference between investing and speculating. Investing means putting your money into something that steadily gains value over time because it produces something. Speculating means you're hoping someone else will pay more for the same thing tomorrow. You're not earning anything, you're just trading positions with someone else, and someone eventually ends up holding the bag. Real investing requires time, sometimes years, sometimes decades. But when your asset is producing value, time becomes your greatest ally. As the business grows, your investment grows. As customers multiply, your returns multiply. Patience rewards you because the asset is doing the work in the background. Speculation, on the other hand, turns time into your enemy. The longer you hold something that produces nothing, the more you depend on the emotional state of the market. And the market is the most emotional place on earth. This is why I've always emphasized staying away from things you don't understand. Not because they're necessarily bad, but because uncertainty clouds decision-making. If you cannot explain in simple words why something is valuable, then you're not investing, you're gambling. And gambling becomes dangerous when you convince yourself you're investing. Another principle I've lived by is avoiding hype. You cannot build a stable financial life by chasing what's popular. Popularity changes. Fundamentals don't. In my career, I've watched sensational trends appear and disappear like fireworks. They shine brightly for a moment but fade just as quickly. But the companies that endure, Coca-Cola, American Express, Apple, these survive because they solve real problems for real people. They have pricing power, customer loyalty, and competitive advantages that don't disappear when sentiment shifts. Bitcoin doesn't have these characteristics. It doesn't serve a real economic function. It doesn't offer a product or competitive edge. Its price swings are driven by excitement, not value. And excitement is a weak foundation for wealth. Your best protection as an investor is knowledge, understanding what you own, why you own it, and how it produces value. When you invest in a business with strong fundamentals, you don't panic when the price drops. You know, the business is still producing, still growing, still delivering value. But when your investment is built on speculation, every price drop feels like a threat because there's nothing beneath it to reassure you. What I want people to understand is this. Long-term wealth doesn't come from chasing quick gains. It comes from choosing productive assets and letting compounding do the heavy lifting. If you find an investment that earns money while you sleep, you are on the right path. But if your investment keeps you awake at night, worried about every headline, every tweet, every rumor, then you're not investing, you're hoping. And hope is not a strategy. That's why Bitcoin doesn't fit into a value-based investment philosophy. It has no earnings to compound, no productivity to build upon, no intrinsic worth to grow. It simply moves because people push it. And anything that relies on being pushed will eventually stop moving when the pushing stops. Investing should feel steady, boring, predictable. Speculation feels like a roller coaster. And the greatest lesson I can give you is this. If you want financial freedom, choose the boring road. It leads to a far better destination. When I look back over the many decades of my life, I don't judge my success by how rich I became or how many headlines my investments created. I judge it by how consistently I followed a set of simple principles that worked regardless of the era, the trend, or the technology of the moment. And one of the greatest advantages of living as long as I have is the ability to see what survives and what disappears. Time has a way of revealing the truth with absolute clarity. In the 1,950 seconds when I was just starting out, the investment world looked completely different. There were no computers, no internet, no smartphones, no high-frequency trading. But even then, the smartest investors were the ones who stayed grounded. They didn't chase what was fashionable. They focused on what was understandable and productive. As the decades passed, new financial instruments came and went. Some were brilliant innovations. Others were illusions that promised much more than they could ever deliver. Through all of it, my approach never needed to change. Buy wonderful businesses. Avoid unnecessary risk. Stay within your circle of competence. Focus on value, not noise. And never underestimate the power of human emotion in financial markets. These beliefs weren't born out of theory. They were shaped by thousands of hours spent reading reports, talking to business leaders, and watching both good and bad decisions play out in the real world. And every time a speculative mania swept across the market, I saw the same story unfold. People would ignore fundamentals and claim that a brand new era had arrived. Words like revolutionary, unstoppable, and inevitable became part of everyday conversation. The fear of being left behind pushed people to make decisions they didn't fully understand. Then, when reality arrived, sometimes slowly, sometimes violently, the same people wondered how they had ever convinced themselves that the old rules no longer applied. If there's one thing age gives you, it's the ability to see patterns that younger investors simply haven't lived long enough to witness. I've seen brilliant companies rise from nothing because they created real value. I've also seen flashy trends collapse because they depended entirely on excitement. And Bitcoin, in my view, falls into the latter category, not because young people are foolish, but because financial history is repeating itself in yet another digital form. People sometimes ask me, Warren, aren't you afraid of being wrong? The truth is, I'm not afraid of that at all. I've been wrong plenty of times. What I fear is abandoning principles that have protected me for almost a century. What I fear is confusing speculation with investing, excitement with value, or novelty with wisdom. That's the mistake millions of people made during the dot-com bubble, during the housing bubble, during every major period of financial euphoria. They stopped asking one simple question: what is this asset actually worth if you strip away the hype? I've lived long enough to know that wealth built on hype rarely lasts. Wealth built on value almost always does. There is also a legacy element to all of this. When you reach my age, you start thinking less about returns and more about what you leave behind, the ideas, the principles, and the lessons that will guide future generations long after you're gone. I want young investors to avoid the pain I've seen countless people experience. I want them to build lives that are financially stable, emotionally calm, and grounded in sound thinking. And that means teaching them to separate real investing from speculation disguised as progress. Bitcoin may feel exciting. It may feel modern. It may feel like the future. But investing is not about feelings. It's about understanding where value comes from and placing your money where that value grows predictably over time. I've watched entire technologies rise and fall. I've watched markets transform. And the one lesson that has never failed me is this: if an asset cannot produce, it cannot protect you. My reflections aren't warnings from fear, they're warnings from experience. And experience is the most honest teacher I know. So when I say that Bitcoin is nearing its end, I'm not making a dramatic prediction or trying to shock anyone. Markets don't collapse on a schedule, and speculative assets don't expire the same way a carton of milk does. What I mean is far simpler and far more important. Every asset that relies solely on belief rather than production eventually confronts a moment when that belief weakens. And when something's value depends entirely on enthusiasm, even a small decline in confidence can cause the entire structure to fall apart. Over the course of my life, I've watched this story repeat itself with astonishing consistency. whether it was the Nifty 50 stocks in the 1,970 seconds, the dot-com darlings of the 1,990 seconds, the mortgage-backed securities before 2008, or the countless hot trends that burned brightly and then disappeared. Each one of them had a moment where reality stepped in. When the music stopped, the people who understood intrinsic value stayed standing. The people who depended on excitement did not. Bitcoin follows this same pattern, not because it's digital, not because it's modern, but because it is built on the same foundation that destroyed every bubble I've witnessed, the hope that someone else will willingly pay more than you did. There is no cash flow beneath it, no earnings to rely on, no customer base to grow, no product to improve, no competitive advantage to protect. And when an asset has none of these things, time becomes its greatest enemy instead of its greatest ally. If there is one message I want to leave you with, it is this: investing is not meant to be thrilling. It is not meant to give you adrenaline or make you feel like you're part of a revolution. Real investing feels steady, patient, and almost boring. It rewards discipline, not excitement. It rewards understanding, not emotion. And it rewards those who choose productive assets that compound quietly in the background for decades. Speculation, on the other hand, is loud. It promises fast results, huge returns, and a path to wealth without the inconvenience of patience. But that kind of wealth is fragile. It cracks under pressure. It disappears the moment sentiment shifts. The lesson is simple. If you want your financial life to rest on solid ground, place your money where value is created, not where value is imagined. Buy businesses with earnings, assets, and long-term competitive advantages. Invest in companies whose success comes from the products they sell and the customers they serve. Put your trust in things that produce, not things that simply fluctuate. Because when you align yourself with real value, you gain something far more important than financial return. You gain stability. You gain peace of mind. You gain the confidence that comes from knowing your wealth does not depend on hype or hope, but on fundamentals that have survived every era and every market cycle. I've lived long enough to know that the future always belongs to those who respect the principles that don't change. And the greatest of those principles is this: money grows most reliably when it is placed in assets that themselves grow. Everything else is speculation, and speculation, no matter how attractive it looks, always carries an expiration date. If you remember only one idea from everything I've said, let it be this: build your financial future on production, not prediction. That single mindset has guided me through wars, recessions, bubbles, crashes, and technological revolutions. And it will guide you too, no matter how bright or enticing the next trend appears. In the end, the market will always reward rationality. It may take time, but it never fails. And if you choose to invest where value is real, your wealth will not just survive, it will endure. And so, after all these decades of observing markets rise and fall, trends come and go, and investors repeat the same mistakes under different names, I've learned one thing above all else. In the end, reality always wins. It may take time, sometimes years, sometimes an entire cycle, but the market eventually separates what is built on value from what is built on belief alone. Bitcoin is no different. It has enjoyed its moment in the spotlight, fueled by excitement, speculation, and the promise of a future many people desperately wanted to believe in. But belief is not the same as value, and excitement is not the same as production. What makes investing so powerful is the compounding of actual value over long periods of time. When you own a business that earns money, that money reinvests itself, grows, multiplies, and supports your wealth, even when the market takes a temporary downturn. But when you own something that produces nothing, compounding cannot help you. Time cannot help you. In fact, time becomes your enemy, because sooner or later the market asks a simple question: what is this worth without the excitement? And if the answer is unclear, the price eventually reflects that uncertainty. This is why I've always stayed away from assets that rely on sentiment instead of productivity. Not because I'm afraid of new technology, not because I dislike innovation, but because every great investment I've ever made has been grounded in one truth: value must come from something the asset itself creates. If the asset cannot generate value, then the only source of profit is someone else's willingness to pay more. And that is not a strategy, that is a gamble. I don't want future generations of investors, young people full of hope, ambition, and big dreams, to confuse speculation with wealth building. I don't want them to be swept away by the belief that financial laws dissolve in the face of something trendy or complex. I've seen too many people learn that lesson the hard way. I've seen fortunes disappear faster than they were created because investors forgot that simplicity is often stronger than sophistication. And sometimes wisdom means stepping away from what is popular and trusting what has always been true. It means choosing the slow, steady path instead of the fast and fragile one. It means accepting that real wealth grows quietly, patiently, predictably, through businesses that produce value, serve customers, build products, and earn profits. That kind of wealth lasts. That kind of wealth endures. That kind of wealth doesn't vanish when sentiment turns sour. Bitcoin may continue to rise and fall in dramatic fashion. It may create headlines. It may attract attention. But none of that changes the fundamental reality. Without intrinsic value, without earnings, without production, it cannot provide the security, stability, or longevity that true investors need. And if your goal is to protect your future, not just chase temporary excitement, then the answer becomes clear. Build your financial life on a foundation that won't collapse. Choose assets with intrinsic worth. Understand what you own. Focus on productivity, not popularity. And remember that the most reliable wealth is built slowly, wisely, and with an unshakable commitment to fundamentals. If you follow that path, you will not only avoid the traps that have ruined countless investors before you, you will also give yourself the opportunity to build something far more valuable than fast gains. You will build something lasting, something resilient, something that can survive every trend, every bubble, and every storm. In the end, that is what investing is truly about. Not excitement, not speculation, but enduring value. And enduring value never goes out of style.